Hello and welcome. This is Michael Brooks and Will Allen with Sentara Capital. We're very excited. We had a great, fantastic year in the markets. We are looking forward to giving you our 2024 outlook. We have 4 major topics we're going to be discussing, and Will's going to give us the details and the nitty-gritty on what you need to know for 2024. Let's start with the Federal Reserve.
Yeah, absolutely. And there's no doubt that over the last couple of years, the Fed have been kind of ground zero for everything as it relates to the markets. It's been so important. And, the big question in 2024 now is how many rate cuts will the Federal Reserve be doing in next year? Because, if you go back even a month, there were still questions as to will they hike more for this rate hike cycle.
Yeah, so tell us a little bit about that. We have a chart that we could put up here just showing what those expectations were and how they changed so rapidly.
Absolutely. So if you look at this first chart, what you'll notice here, this is the odds that the Federal Reserve will be cutting interest rates by their March meeting. And what you'll notice there is in October and November, those odds were very, very low. But you can see once we got here into late November and December, this has moved straight up to basically a situation where the market is saying there's an almost 90% chance that the Federal Reserve is going to be cutting interest rates in March for the first time in this cycle. If you have not had a chance to watch our last market update video that we did, you can go to sentaracapital.com, and at our market news, you can see that video where we talk about the fact that the Federal Reserve basically did a pivot at their meeting earlier in December, pivoted away from a rate hike cycle to we're now going to be cutting interest rates in 2024.
Yeah, so that was great news. Markets responded well. What did the Treasury rate do?
Well, that is what is so interesting. So if you take a look at our second chart, and what you'll see on here is we have the Fed funds rate in this chart along with the 2-year Treasury rate. Now, again, that is a rate on a 2-year Treasury bond that is basically set by the market. And what you'll find so interesting, take a look during the 2021 and early 2022 timeframe, and you'll notice the orange rate, the 2-year Treasury rate, goes up long before the Federal Reserve started hiking interest rates. And that was the market saying, hey, you're behind the curve here, you should have rates higher. And you'll notice that the Fed basically was playing catch up all throughout 2022. Until you finally reached a point where the blue line, the Fed funds rate, caught up to the Treasury rate. You've basically spent the last 6 months, 9 months with those two staying pretty close to each other until, like you said, the last month. And you'll notice that the 2-year Treasury rate has gone down significantly in the last month, and that's basically been the market telling the Fed, hey, it's time to start cutting interest rates.
Yeah, so what's interesting about this now is this where we're at in the last month or so. Now the spread between the Fed funds rate and the Treasury rate is pretty stark compared to what we've seen all in the past. I mean, you can look back in the 2010s, for instance, and the 2-year Treasury was above the Fed funds rate for a very long time coming out of the financial crisis. Now we have that flipped, and we have a good pressure down on rates. So can you just give a little bit of a highlight of just those last couple of weeks and what they've meant for that spread between the Treasury rate?
Yeah, and basically you've seen whenever in fact you can even go back 50 years and to look at every Fed rate hike cycle and cutting cycle. And basically the fact is once you reach a point where the Fed's funds rate is above the 2-year Treasury rate, which it is now, when that 2-year Treasury rate starts to drop and the spread widens, the Fed tends to cut within 6 months
Okay,
of
so
that
that's
taking
where
place.
the market is really thinking the Fed will cut several times coming up.
Yeah, and that's a question you and I have been talking about, the fact that right now the Federal Reserve in December they gave their projections for where they think the Fed funds rate will be at the end of 2024,
Right.
and that rate was at 4.6%. That implies that they'll cut interest rates 3 times next year. Well, if you look at market pricing right now, the market is pricing in 6 rate cuts for next year, which to us that seems a little extreme.
Right, 6 times would be every other month.
Yeah.
They would cut.
Yeah.
25
basically,
basis
yeah.
points,
Exactly.
normally. So, but we don't think it's quite that extreme. But 3 sounds pretty reasonable. I mean, that's
Yeah.
probably something.
Yeah,
in
I
that
mean,
neighborhood.
in a world where inflation is going back towards the Fed's 2% target, it's not there yet. We've talked a lot about the fact of where inflation is. But the fact is, they moved interest rates to that 5.25% to 5.5% range to try to bring inflation way down.
Right.
And the fact is, inflation peaked at 9%. Today, it's between 2.5% and 3%, depending on what you're looking at. So a Fed funds rate of 5.25% to 5.5% is not necessary when you have inflation down like that. So yes, 3 rate cuts, 4 rate cuts next year would seem reasonable. The only way that we can really see, and we've talked about this, see 6 rate cuts were to be if we see a recession next year.
Yeah, I was going to say they would have to be something pretty extreme for
Yeah.
the Fed to drop that quickly.
Yeah.
Okay. Well, related to interest rates very closely and practical that we all deal with on our everyday, or a lot of us deal with on our everyday basis, is housing. So let's go to housing now, and what is that looking like next year?
Yeah, and I think the reason that we picked this as point 2 is just the fact that it is a very important part of the U.S. homeowners and equity in the home. It helps consumer confidence and spending when housing prices are going up. But the fact is that we all know that early on when COVID happened, home prices soared. And home prices went up about 40% in about a 3-year period. In fact, we have a chart that shows the Case-Shiller Home Price Index. And so you'll notice here that home prices, when you see 2020 hits and they went straight up, you had 20% year-over-year increases. And then you followed that up with another year of 18 to 20% home price increases. This dropped a lot last year, but prices were still going up. We're just going up
This
at
is
a
the
much
growth
lower pace.
rate.
Yes.
That we want to say, not necessarily. Don't look at this at like these are where home prices on average have been. This is the rate of growth.
That's exactly right. That was the rate of growth. You had, late in 2023, for about a month or 2, you had home prices dip into the negative year-over-year level, and this is for existing homes. New home prices actually have dropped by about 10%. Home builders cut those prices and bulked down mortgage rates to sell a lot of inventory. But these are for existing homes, which that's most people. And what you'll notice here is that in the last 2 months, this has started to go, home prices have started to go up again. And you'll notice 4.8%, and that is today, by the way. This data just came out.
Right.
Basically 5% year-over-year growth. And so what you and I have been talking about is this concept of, okay, if home prices go up more, where is that going to put the average consumer? And we have a good chart about this.
Yes. Let's get into the cost increases here, because that's where people have obviously been impacted by inflation, and this is a very good example of the combination of interest rates and mortgages and home prices. So detail this.
Exactly. You had 2 things happening at the same time, for the last couple of years. You had home prices going up significantly, and you had mortgage rates going up. I think in August, we did a video and we looked at the fact that if you use the median home price and the median salary, and you looked at those combination, and we said that a mortgage on average was $1,100 a month 3 years ago, and it got to over $2,700 a month now due to the combination of higher prices and higher mortgage rates. Let's put up this chart, shall we, of talking about for your median, the person in this country with their median income, what percent of your salary would you need to spend to go towards your housing cost, including obviously the biggest thing is your mortgage. And you'll notice going back to 2012, at that time it was about 20% of your salary. And you can see that that steadily went up, but we've seen a significant increase since 2020 from 28% of your income up to 41% of your income. And the fact is that is just not sustainable for a household to be spending 41% of their income towards housing.
Right. So folks who are wanting to get into a new home, this puts a pretty big lid on potential new buyers, etc., which is, slowed down the housing market for sure. But you mentioned the price not only is the percentage of the Federal Reserve, what they're putting out with the rates. So let's look at that last chart here. And where's the mortgage rate at now?
So right now mortgage rates, and we'll put that chart up, is at 6.67% on a 30-year mortgage. That's down from a peak above 8%. And so 6.67. If the 10-year Treasury yield continues to go lower, then that 6.67% can go lower. There's also the spread between the 10-year Treasury and the mortgage rate. We're not going to get into the math on that, except to say that the spread is very wide right now. That could definitely come in. And so it's possible you could be looking at mortgage rates in the 5s. And that would be very, very helpful, because the idea here is that over the last couple of years, 75% of homeowners had mortgage rates below 4%. So many of them at 3.25, some even in the 2s. They weren't going to move and give up that rate for an 8% mortgage.
Right.
But if rates keep coming down on that 30-year mortgage, then all of a sudden a lot of these people may have said, okay, we want to move. And they put their homes on the market. And if you have a lot of supply come on, that could bring housing prices down some. And if housing prices come down and mortgage rates come down, then all of a sudden that percentage, instead of being 41%, that could come down into the 30s, and that could make it much more affordable for your average person to buy a house.
Well, awesome. Great news on interest rates in the housing market. Let's take our attention now to the stock market, because we've got a lot of things that are looking positive for next year.
Yeah, absolutely. And I thought with this, what we could start with is just a flashback. Last week, we put up a chart that was talking about the 2023 end-of-year price targets that the major Wall Street firms had and chief strategists. We'll put that back up if you have not gotten a chance to see that. And we're just putting this up to highlight again. It is tough having a price target and these firms trying to figure out where the market's going to go. We just want to highlight that this year, coming into this year, most strategists had the market in the 3,000s to low 4,000s for the S&P 500. It's at 4760. You can see at the top line there, Tom Lee, who we are clients of. We subscribe to him and his research. He's a third-party research firm. And he basically nailed the price target for this year, which was kind of cool. But now we have updated 2024 targets that I thought we could look at for the first time. And, I think what stands out here, and you mentioned, Michael, when you saw this, that we don't see anyone in the 3,000 level anymore.
No 3,400s like last year, so that's good news.
Yeah, they don't see a substantial decline. Yeah, most of these targets, we got 3 or 4 of them that are pretty close to where the market is now, and then we have 4 or 5 of them that are in, 5,000, 5,100, 5,200 kind of level. So, what I would say is most of these strategists see that the market's going to be up or down, 5%, 10%, no major moves either way. But again, this is a hard gig. A lot of times this is kind of what analysts or these forecasters do, is they project, the market's going to be up 5 or 10, or it's going to be down 5 or 10. And then oftentimes, it's nowhere close to that.
Yeah. Well, In another subsection of the market, let's talk a little bit about small cap stocks specifically. So we can get into that chart going back a few years and tell us what we're seeing here.
Yeah, this is a very important piece for investors in 2024 because, for much of 2023, the kind of storyline was that the big tech stocks known as the Magnificent Seven, they were up 30%, 40%, 50% for the year, while the rest of the market was basically flat for a lot of the year. In the last month, that has changed. A lot of the rest of the market have really gone up a lot, and small caps are a real piece of that. Why that's important is that oftentimes, if small caps are working, if they're going higher, the markets can have some really, really strong years. A lot of times when small caps go up, they don't just go up 5 or 10%. They'll go up 25, 30, 40%. That's the kind of moves they make. It's the pattern that really we want to showcase for folks today. So let's put up a chart of the Russell 2000 small cap stocks going back to 2019. And you'll notice that they have these stretches where they trade in a given range. In 2019, you'll notice the black lines, and you'll see that the Russell 2000 kind of came back to that line almost to a penny 3 different times. A lot of buyers emerged at that level. Then, when COVID happened in early 2020, what do you notice there happened with that range?
Yes, it broke.
Yeah, it breaks. And what happens is a lot of these investors who go by technical analysis, when they see the trend breaking, they sell. And so you then see a much stronger move lower in that situation. Then you had small caps recover once kind of the market recovered from the initial COVID lows. But then what you'll notice in 2021, I think we counted that the small caps came back to that line 8 different times.
Yes,
it basically comes back to a penny, right. And that's these. There are a lot of traders who go by this kind of analysis, and so they're buying every time it comes back to that level. Then when it breaks that level in early 2022, again, you get another steep decline after that drop. Then in late 2022 and 2023, notice that we have 2 lines there, both on the upside and the downside, and it ping-ponged back and forth, these small caps in the year 2023 in that level. But look at what happened late last week, Michael. You get a breakout above. Do you see that there?
Yes, right at the tail end there, it has broken through a pretty, again, we've had floor to ceiling a lot in the last year and a half with no major movements, but we got one the last couple of weeks.
Yeah, so this could be a big deal because, again, there are a lot of investors who track this and will come in and start buying. And so this is something that really is a positive for small caps in 2024. We mentioned Tom Lee a little earlier on the price target list. Well, Tom Lee has small caps as his top sector for 2024. We like to see that as well. And if small caps can work, that can be a positive.
That's right.
Let's talk about the last thing we want to talk about here as it relates to the stock market is the concept of the S&P 500 going back to 1952 during election years.
Yeah.
And so we'll put that up for the folks to kind of see. And what really stands out to me, and we, by the way, had this chart back in early December in one of our videos, but what you'll notice here is that the S&P 500 has been higher every single election year with the exception of 2000 and 2008. And you'll notice that those were both years where a recession took place in those years.
Right, tech bubble and the housing crisis.
Yeah, exactly. So two significant recessions there. As of right now, we don't project a recession in 2024.
Nor is anyone else, what we saw from the research that we pulled up the strategists before.
Exactly. And by the way, we should highlight for folks what a change that is, because coming into 2023, pretty much 90% of economists were expecting a recession. And that's, again, a big reason why a lot of those price targets were low. We were of the we took the stance in our videos here that we did not foresee a recession happening, that we thought the economy was going to be stronger than a lot of these folks anticipated, and that's kind of exactly how it turned out. Well, now in 2024, a lot of these people are expecting the economy to have another pretty good year. I don't know if we should be afraid of that, because a lot of times when they all get on one side, they're wrong. but that being said, the fact is that we highlighted a couple times in the last 6 months when seasonality, and that's what we call this presidential calendar year cycle, is seasonality. It doesn't guarantee anything. The market could be down this year for all we know, but it gives you a guide that in the past, this fourth year of the presidential cycle, the market has tended to do well. We had something very similar that we posted on October 7th on our blog, where we mentioned the fact that 9 of the last 10 years in the fourth quarter, the S&P 500 had been higher and on average up over 7%. And sure enough, the market's going to go out with about a 9 or 10% gain in the fourth quarter. That's going to make 10 out of the last 11 years, that the calendar, that's had a big impact, right? We also talked about last year, after the midterms happened, we went and looked back, going back to 1950. The S&P 500 had been higher every single time that a midterm happened for the following 6 months and year, and on average up over 15%. And sure enough, in that 1 year, it was up over 16%. So we care a lot about seasonality, because a lot of times these tend to repeat these cycles. And so we have to kind of pay attention to that. But those are just some things that we wanted to point out, that as we go into 2024, that we think that's important. And of course, like you mentioned earlier, when we're talking about setting price targets, a lot of things change and a lot of things can happen. And so that's why we keep updated here. And as things change, we take a look at it as it relates to client portfolios.
Yeah, so speaking of our 2024 outlook, I think we covered a lot of great our bases there. So let's just talk real quick and end this video with what are we planning on? What are we excited about next year? We've got a lot of content coming, some extra things that we haven't quite gotten to yet. So I just wanted to kind of talk through that a little bit.
Yeah, absolutely. So obviously folks have noticed that we have significantly increased the amount of content we're putting out, and we've been doing a lot of market updates, and we're going to continue to do market updates. But we also have some cool new tools for clients that you have spent a lot of time really fine-tuning and working with some clients early on and kind of rolling it out.
Yes.
Tell us a little bit about Elements again.
Yeah, so Elements is a financial monitoring application that we're using with folks to really track it, where they're at with their finances, and then gives us some data points in order to suggest improvements, making sure you're making the right amount of contributions, or looking at your debt and paying off in the right way, things like that. So we're really, for accumulators, we're really excited about that. And then for our retirees, we are continuing a lot of our bucket strategies and implementing those for client portfolios. So we'll be going into a lot of these different tools in other videos later this year. And that's another thing we're going to be adding to the queue. So.
Yeah, and we hope you'll like it. And just as a reminder, if you're watching this here on YouTube, to like and subscribe to the channel, share this with friends or family. Again, if you have friends or family who are not hearing from their advisor, who say, we just don't have much communication, or they're not getting updates related to their portfolios, give us a call. You can go to SentaraCapital.com and you get all our contact info there, and we can set up an initial phone call. And that should wrap it up for 2023.
Yeah, 2023. We're done.
Take care.
Yeah.
Good hires to a good 2024.